Hi there. One of the most important questions which most first time investors or new investors have is how often should they invest? Or what's the time interval within which the investments should be made? This question is further compounded by the fact that there are a lot of ad campaigns these days, like mutual funds, Sahi Hai, and there's a lot of chatter around SIPs and dollar cost averaging. These are these are a lot of terms that I have already thrown at you. Now let's understand the most basic question in investing. How often should I invest? Now, it's a well-known fact that the history of financial markets have shown that stock prices and equity indices generally tend to appreciate year over year. But there are periods when the market goes up, and there are periods when the market falls like there's no tomorrow. In such a situation, pacing your investments and investing consistently is extremely critical. Now, there might be a very savvy investor who would be able to predict stock prices well in advance, and they may have the divine intervention to invest when the markets are at an all time low, and they'd have the intellect to withdraw their money during the market peaks. But considering that we are all normal investors who are not aware of what the market is going to do tomorrow or what the market is going to do 10 years down the line, being consistent is the most important thing in these stock markets. Now, what do I mean by consistent? It just means you commit yourself to invest over a regular interval of time. This interval could be once a week, once a month, or once a quarter. You commit yourself to investing across these time periods regularly over a long period of time. For instance, you might decide that on 25th of every month I receive my paycheck, so I'll invest a certain sum of money on the 25th of every month. This investment decision should be regardless of the value of Nifty, and it should be regardless of what financial markets have done in the preceding 1 month or 1 year. Now, for instance, if you invest consistently every month, it lets you get away with bad investment decisions. Now, let me give you a very simple illustration of a very unlucky investor who decides to invest in Nifty 50 during the peak of the bull run in 2008. Now, this was a very bad time to invest, which is pretty evident from the chart that I'm showing you. Now, for instance, assume that during 2008, in the month of January, I decide to invest 10,000 rupees. And this 10,000 rupees gets invested every month, which means every month I'm putting in a fresh capital of 10,000 rupees. Now, the interesting point to notice, even though I start at the worst time possible, that is, I start at the peak of a bull market, I eventually end up making gains 15 years down the line. Incidentally, the break-even point occurs somewhere after 18 months, which means even if you were to enter the market during the peak of a bull run, 18 months down the line, you are at a break-even point. And this is a very important takeaway for any investor. You can decide to invest at any point of time. You will still witness a capital appreciation as long as you're consistent in your investment pursuit. Now, for someone investing during the peak of the bull market in 2008, there would have been, or there were periods in the interim when the Nifty fell as much as 26% in a given month. Such sharp falls should not deter you from making your investment. Come what may, you should keep on investing month after month. Now, the other important takeaway from a very simple analysis that I've done is, when you invest consistently across market up moves and market down moves, it lets you reap the benefits of a good up move, and at the same time you can wash away the sins that you made during the peak of a bull market. Now, you might have been too excited during the peak of a bull market and you would have decided to make all your investments during the peak. But if you're consistent, you can still get away with such mistakes. Eventually, the history of financial markets have shown that consistency is rewarded. Nifty during 2008 was at 6136. It went all the way down till 2700 or 2800, which is close to a 60% fall. But eventually, if you're consistent, you would have still ended up making money. Now, this is a very simple strategy, isn't it? Invest consistently every month, irrespective of what the Nifty or the Dow Jones has done in the preceding 12 months or 1 month. Eventually, you'll end up making money. Now, this is a very simple philosophy in theory, but it becomes difficult to implement it. Let me tell you the reasons why. When the markets are going up, you feel really motivated, you're happy that the Nifty is going up, so you decide to make your investments and you're very happy. But when the market falls around 20 or 30% in a single month, which happened during 2008, it happened during the coronavirus pandemic, motivating yourself to invest when there's blood on the streets is extremely difficult. But just go back to history. Every down move is followed by an up move, and every down move is a good chance to buy your favorite stock. So be consistent and pace your investments over a regular time horizon. This regular time horizon depends on every investor. For some person, it might be a weekly investment. Some might have the luxury of doing a monthly investment, or some people might be a bit hard pressed, so a quarterly investment makes sense for them. Stick to your own timelines and run the race according to your pace. Investing is a marathon, it's not a sprint. So be consistent with your investment decisions, and eventually you'll end up making reasonable returns, which not only beat inflation but give you a reasonable cover over and above the risk-free returns.